Hello everyone, welcome to today's session. So today we are going to discuss a very important chapter, which is the audit of banks and NBFC. Now, why I say important is because if you see, this particular chapter is divided into two units. Okay, unit number one, which covers the audit of banks, unit number two, which covers the audit of NBFCs. Okay, now if you see these both chapters, okay, these chapters are based on the regulations. These chapters requires an auditor to understand the regulation which are there for the banks and for the NBFCs, and accordingly auditor is required to audit these kind of special entities, I would say, which is the bank and the NBFC. So your chapter number 14 basically is divided into two units, unit 1 and unit 2. Now today, as we do in all the LVRCs, that we will basically cover these both units, okay, through the questions. We will solve some questions, and I will also take a relevant amendment which will be applicable for your exam, and this is relevant to the NBFC chapter, okay. And accordingly, we will discuss both of the units, and we will solve some questions on both of the units, and accordingly, we will clear out some topics on these particular units. Okay. Now, sorry. So first, when I talk about special features of audit or banks and NBFC, in your study material and in your paper 3, this is part of section 3. Okay. Section 3 covers 17 to 24% or 24 marks, okay, which covers group audit, NBFC, audit of a PSU, internal audit, and forensic accounting and investigation. So the entire section 3 covers 17 to 24 marks, which includes this chapter 14 also. Now, to give you a background about NBFC and bank, so first we will start with the relevant amendment, and then we will cover accordingly. So just to provide you a brief background about the amendment which is there, which will be applicable for your exam. Number one is there was an amendment with respect to the classification of the NBFCs. Earlier, if you have gone through the study material, the NBFCs were classified into base layer, middle layer, upper layer, and the top layer. Okay, top layer and the upper layer. Okay, so these were the NBFC classifications as per the 2023 scale-based regulations. Now there has been addition to the scale-based regulation. Now addition is they have added unregistered type 1, type 1 registered, and type 2 registered. So 3 more things which have been added to the classification. Type 1, which is registered, unregistered. Type 2, basically, which is registered. So if I talk about type 1 can be unregistered and registered, and type 2 always registered. There is no unregistered in type 2. Okay. Now, from where this classification is coming and how you can classify between the type 1 and type 2 NBFC. So the type 1 and type 2 is based on the asset size and customer interference. Okay, so basically, if there is no public acceptance of fund, the asset size is less than 1 CR, and there is no requirement of customer interaction, in that case, it can enjoy the exemption of the type 1 unregistered. That means the NBFC is not required to get registered. Simply 3 conditions. Number 1, asset size less than 1000 CR. Okay. Number 2, no deposits. Number 3, no customer interaction. Okay. If these 3 conditions are getting satisfied, you can go under unregistered category. That means you can avail exemption from registration. Simple. Avail exemption from the registration part. Pretty much straightforward. Okay. Now, if you breach this particular part, that is, if you breach the asset size, that means your asset size is more than 1000. If it is more than 1000 CR and still no deposit, no customer interface, it falls under the type 1 registered. The moment you go more than 1 CR asset size, you have to get yourself registered. So the type 1 unregistered and type 1 registered, the difference is of the asset size. The moment you cross 1000 crore asset size, you have to get yourself registered. You will lose the exemption. Now type 2 register. Type 2 register means either you accept deposit, okay, either you accept deposit or you have a customer interface. Okay, if any of the rest of the condition is getting satisfied, you will directly fall under the purview of type 2. That means over there, you are a type 2, you have mandatorily get registered irrespective of your asset size. It does not matter whatever is your asset size. Okay, if you are falling under the category where you have a deposits or where you have a customer interface, okay, if any of these condition is being satisfied, irrespective of whatever asset size you have, you are type 2, you need to get it registered. Clear? Okay, so that is one very good amendment and big part. Apart from the base layer, middle layer, upper layer, and the top layer, this is type 1, type 2 registration. That is when you are required to get registered, when you are not required to get registered. So a simple table for your understanding. Unregistered, type 1, strictly none. There is customer interaction, should not be there. Acceptance of public fund should not be there. Asset size less than 1 CR, go for exemption. You can get the exemption, you can get unregistered. Customer interface not there. You don't have a public fund, but greater than 1 CR. The moment you cross the threshold, based on the asset size, you shift from unregistered to registered. You need to obtain registration certificate mandatorily, and accordingly, all the things will be applicable to you. Type 2, irrespective of this, if you have accepted the public funds, if you have the customer interface, type 2, that means you have to get yourself registered. And then the base layer, middle layer, wherever the registration comes, then the further classification of the base layer, middle layer, top layer, upper layer, all these will come into the picture. Okay. Now, another, just I will brush upon few things with respect to the amendment is that there has been change in the nomenclature of the regulations which were there. So earlier there was scale-based regulations. Okay, non-banking of money financial scale-based regulation directions 2023. Now, on 20th November 2025, what RBI did is RBI divided these directions or regulations into different directions. Okay, so now after 20th November 2025, you don't have a scale-based regulation direction 2023. You have a new set of directions which are kind of, you can say, splitted version of this SBR. SBR was a very big consolidated directions. And on 20th November, RBI split that particular big directions into a very segmental level directions. That, for example, so RBI non-banking financial companies registration exemption and framework of scale-based regulation direction. That means one direction for the registration, one direction for the prudential norms, one direction for the income recognition and asset classification, one direction for presentation disclosure. So all these different directions have been brought into. Material wise, they are same to the scale-based regulation, just there is a split in the direction. Okay, so whenever you have to code the directions, remember there is a new name for the direction which is there after 20th November 2025. Sorry. So this is one very important update which was there for 2026, which was there on the various places where that has been issued. Now let us take some questions, and accordingly we will discuss further topics with respect to unit number 14. Sorry. Okay, we will start with some questions, and we will start with unit 2 first, which is the NBFC. The question is, Singh Limited is a company registered under Companies Act 2013. The company is engaged in the business of loans and advances, acquisitions of shares, stock, bonds, debentures, securities issued by the government or local authorities. For the year ended 31st March 2024, following are the some extracts of the financial statement. Paid up share capital 50 CR. Non-current assets, loans and advances 61.75 CR. Current assets, loans and advances 31.25 CR. Total assets 620 CR. Intangible 12 CR. Profit for the year 7.25 CR. Income from interest and dividends 68 CR. Gross income 118.75 CR. Based on this, directors intend to apply for the registration of NBFC under section 45 IAF RBI Act accordingly. Now you need to advise on this particular scenario. Take a minute, read the question, and then tell me what do you think. Okay. See, basically, when I talk about registration of the NBFC, there are two important things that we need to understand when a particular NBFC is required to register. So, if we go to the study material, and we will check, we will discuss from the study material itself all the things. So, if we go to the study material, yeah. So a particular company will be counted as an NBFC if it has a principal business of non-banking financial company. Okay, we need to understand what is principal business. If a principal business of a company is of a NBFC, in that particular scenario, we need to get it registered. Now, what is a principal business? How can you identify a principal business is of NBFC? So, if the financial assets constitute more than 50% of total asset, and the income from financial asset constitute more than 50% of the gross income. If a NBFC fulfills this criteria, that means the NBFC is into the business of non-banking financial company. Okay, and any company who is into the business of non-banking financial institution or company can only operate once they obtain the registration under section 45 IA. Now let's go back to our question. So basically we need to apply 50-50 test. First of all, to understand whether it is getting classified or not. Sorry. So if I talk about 50-50 test, okay, so my 50% of the total asset should be financial asset, and sorry, and out of the total, the income from those financial asset should be more than 50% of my total income. So first of all, let's understand what is your total asset over here. Your total asset is 620 CR. Okay, total asset is of the company is 620 CR. But very big part that we need to understand here. Are we required to reduce any amount from the total asset? Answer is yes. If you go back to your study material, there is a one important line. It should be netted off by intangible assets. That means whatever your total asset is there, it should be after intangible asset. Now let's go back to the question. Now in our case, there is an intangible asset of 12 CR. So I have to net off these two numbers, and whatever amount I will get, let's say 608 CR is my total asset. Now I need to compare this total asset, and I need to see whether my financial assets are more than 50% or not. So what is my financial asset over here? My financial asset, someone will say, sir, your financial asset will be 312 CR, current asset which are shown in your balance sheet. 312.25 CR will be your financial asset. Someone will say that, sir, this is current asset, it could be financial asset. What about non-current asset? Can I take this as a financial asset? Should I take this as a financial asset? Yes or no? So yes, I will take this as a financial asset because these are also loans and advances. So the total of these two will be my financial asset. So if I total these both, okay, 370, sorry, 380 CR, 374. Okay, 374 CR will be the total amount of my financial asset. So my financial asset became 374 CR. Okay, 374 CR and 608 CR. Now I need to compare whether it is more than 50%. So 374 is obviously more than 50%. Okay, so when you will calculate the ratio, it will come more than 50%. So the first condition of the 50-50 test, that is my financial asset should be more than 50%, is getting satisfied. Now, second, the income from these financial assets should be more than the 50% of your total income. So income from financial asset, that is income from interest and dividend, is 68 CR. Gross income 118.75 CR. Now tell me, do I have that income more than 50%? So do I have income more than 50%? Answer is yes. If I take this as a financial income and this as a total income, okay, this is my financial income and this is total income. Obviously, it is more than 50%. Over here is more than 50% of my total income. And interest and dividends are obviously coming from my loans and advances. So I'm meeting both of the criteria. So this is over here, I'm meeting the 50-50 test. And as a result, they can apply for the registration. Now, one question based on the recent amendment. Understand one thing. Here they intend to apply. Although there is, if you have an exemption, there is no restriction that you cannot apply. So as per the type 1 unregistered or type 1 registered, the amendment that we discussed, there is an exemption given to you. Okay. So if you do not wish to avail that exemption, perfectly fine. You can go ahead and get yourself registered. There is nothing stopping you in those scenarios to get yourself registered. But you can avail the exemption only when you can satisfy those conditions. So here, if your total asset size is less than 1,000 CR, okay, over here it's less than 1,000 CR, and there is no acceptance of deposit from public, but in the question you already have an advance, loans and advances which you have given. I have no information of acceptance of public deposit liabilities. In that case, I cannot comment whether the exemption is available to this particular entity or not. Only when the information is given, I can only comment, okay, whether there is no customer interface, there is no acceptance of deposit, and accordingly, In such a scenario, the asset size is less than 1000 CR, exemption is available. Because of the lack of information, I will not go to the exemption. Information is not there, and accordingly, I will only answer the question from the perspective of principal business test. Okay. So let's see the answer. When you have to write the answer, you need to specify like what is the provision basically. Okay. So financial assets more than 50%, income from financial assets constitute more than 50% of the gross income. And then you need to provide the calculation. Okay, what is your total asset? Netted 608 CR. What is your financial asset? 374 CR, the total of current and non-current both. Income, gross income, and accordingly, you meet the principal business test and can apply for the registration under Section 45 IA of the RBI Act. Any doubt? Any doubt? Okay. If you have a doubt, you can ask your doubt in the query box, which is there. Okay. If no doubts, let's proceed forward. Proceed further. I have one more, good question for the NBFC. The question is, Manu Finance Limited is a non-banking financial company and was in the business of accepting public deposit and giving loans since 2019. The company was having net own funds of this much, 1 crore 75 lakhs, and was not having registration certificate from RBI and applied for it on 29th March 2024. The company appointed Mr. Yuvan as a statutory auditor for 23-24. Advised the auditor with reference to the audit procedures to be undertaken and reporting requirements on the same in the view of CARO 2020. So a question which is there on the NBFC regulation plus on the similar times, the question is dealing of a point on the CARO. So it's a combination of the CARO and your NBFC. Okay. So tell me, what do you think? What auditor should do in this scenario? Anyone? Anyone? No? Okay. So basically, see, now in this particular scenario, first of all, understand what is the reporting requirement for the auditor. Let's go back to your study material and we will discuss that. So I will just go below. Yeah. So on your study material, if you come on 14.113, page number 14.113, over you have a 0.7.2, which is compliance with CARO 2020. Now, as an auditor, we are required to report on few matters which are there in the CARO itself. Okay. One such point is where you need to report that whether the company is required to be registered under Section 45 IA of the Reserve Bank of India Act, and if so, whether the registration has been obtained. Second, whether the company has conducted any NBFC activities without the certificate of registration, without obtaining the COR from the RBI as per the Act. Okay. And whether the company is a CIC, that's a core investment company, and whether it fulfills the criteria of the CIC. Is it an exempted or unregistered CIC? Whether the group has more than one CIC of the part of the group is yes, indicate the number of CICs. So that's the paragraph 16 of the CARO. Okay, where you need to report on these matters. Okay, basically whether the company is required to obtain the COR. If it has obtained, then whether it is whether it has conducted the business after obtaining the COR, then the CIC related reporting. Now, another part is there is another obligation on the auditor. There is another obligation on the auditor. The obligation on the auditor, another obligation is auditor is required to report on a few different matters with respect to uh, the non-compliances. But in the given question, we are only specifically asked about CARO 2020. So we will restrict our answer accordingly. So number one, whether the company was required to obtain the certificate of registration. So here the question says that the company was in the business of accepting public deposits and giving loans since 2019. Accepting public deposit and giving loan. So in that case, is the company required to obtain registration? Yes or no? You will say, sir, this is not a principal business test. Then in this particular case, we don't think so. They are required to obtain certificate of registration. We need to take the 50-50%. Most of you will say that only. So they are required to obtain this 50-50 criteria. Then only basically, they are required to obtain the registration. See, again, over there, the 50-50 criteria is from where it is coming. It is very important to understand that. And accordingly, you will be able to understand when 50-50 criteria is there, when it is not there. So not every time you need to apply 50-50 criteria, because where the registration requirement is and how the registration requirement is coming, that we need to understand. And for that, I will take you to the RBI Act. And we will understand over there when the registration requirement is, coming from the 50-50 and when it is coming otherwise. Okay. So let me go to section 45I. Okay, 45I, which is the definition for the NBFC chapter. And accordingly, there are few definitions that I'm required to discuss over here. Okay. So first definition is 45IA. What that definition says is that a business of a non-banking financial institution means carrying on business of a financial institution referred in clause C includes non-banking financial company referred in clause F. Now, why we are looking into this particular definition of business of non-banking financial institution? Because if you read 45IA, okay, section 45IA, it says that non-banking financial company shall not, undertake any business of non-banking financial institution. So, see, this is 45IA. 45IA basically talks about this business of non-banking financial institution. You should not go without the certificate of registration. Now, this is coming to the definition over here. Okay. Now, it says that if you carry on the business of financial institution, which is there in the clause C, or if you carry on the business of non-banking financial company, which is in the clause F, that means you are doing the business which requires the COR. Okay. Certificate of registration. Now, what clause C says? Clause C basically talks about what you, with respect to financial institution, what financial institutions do. Okay. So if you are a financial institution and if you carry out the business of financial institution, in that case, clause C, basically governs it. So let me show you clause C. This is clause C. Clause C talks about financial institution making loans, advances, okay, acquisition of shares, letting of goods on delivery, carrying on insurance business. A lot of things are there. But this is one, making loans and advances, or otherwise any activity other than its own. So if you are into the financing, okay, if you are into the financing, then in that case, it will be this particular, financial institution activity. And when I talk about F, F says is that you are into the business of a financial institution, which is a company, okay, which is again refers to the C. NBFC having principal business of receiving deposit under any scheme or any other manner, okay, such other banking institution or class as may be notified. So this is where the principal business is coming. 50-50 test. So this is where we are talking about the 50-50 test, principal business. When you say principal business of receiving deposit, that means you need to satisfy the 50-50 test. That is a clause F. But if you are falling under clause C, that is making loans and advances, you are falling under A, okay, and then you need to take COR. So COR not only depends on the 50-50 business, but it also goes to the other activities which are under clause C. 45I clause C, which is financial institution making loans and advances. Let's go to in our basically question. Our question says it's giving loan, accepting public deposit and giving loan. Giving loan is already covered in clause C. That means irrespective of my 50-50%, I need to obtain the certificate of registration. Now, if I am required to obtain the registration certificate, okay, in that case, as an auditor, first of all, I need to report whether the registration of certificate was obtained, because it is a prior requirement that without obtaining, you should not start. If you see 45IA says that you need to obtain prior certificates of registration, then you go and start everything. Okay, this is that before commencing. Shall commence on carry on without, means no banking financial company shall carry on the business of this without obtaining certificate of basically registration. So if you don't have a certificate of registration, you cannot commence the activity of the NBFC. So I'll just add over here. So you need to obtain this certificate of registration before commencing the activity. Here they have doing since 2019, but they applied for 29/2024. Accordingly, I need to report whether they were required. Yes, they were required. They obtained, they did not obtain, and they were carrying on the activity without certificate of registration. Third, whether it's a CIC. There is no registration, so we will not go on to the CIC. But again, to give you an understanding, CIC stands for, you can say, these are the investment companies, okay? Core investment companies, or basically, these are the group companies. Basically, core investment company is kind of a company which holds the investment within the group entities and group structure. It has very less to do with respect to public holding. So if I talk about the CIC, NBFC CIC, 90% of their net asset are the shares, bond, equities of the group companies. You can assume CIC as a holding company. If I have to summarize in short, CIC is nothing but a holding company. Okay. Now, when I talk about CIC, here they are accepting public deposit and giving loans. So there is nothing with respect to the group holding. So this is not a CIC as of now. And CIC part will not be applicable. And in exam also, if there is something with respect to the group companies, holding of group companies, shares, securities, bond, and on that line, then only the CIC can be triggered, but otherwise not. So here, CIC will not be applicable, and accordingly, you need to report. Okay. Let's see the answer. So as we discussed, clause 16 of para 3 of CARO 2020, auditor is required to examine whether the attracts the requirement of registration. whether the financing activity is a principal business activity, and accordingly what they are required to do is, so the auditor should examine transactions of the company, whether they are in relation to a NBFC, whether the 50/50 criteria is applicable or otherwise applicable, whether the company has a net own funds that required, whether the company has obtained registration as an NBFC. If not, then the reasons thereof, and accordingly the auditor is required to report. So in this scenario, the Manu Finance Limited is an NBFC giving loans since 2019. Net on funds less than 2 CR. So the prescribed limit for the NOF is 2 CR, but it is less than that. They don't have the registration certificate. And accordingly, auditor is required to report in that particular paragraph. Which paragraph? The paragraph we saw. This one. Whether the company is required to be registered under Section 45 IA. If so, whether the registration has been obtained. So you say yes, required to register. Not obtained, then reasons for that. Whether the company has conducted any activity of non-banking financial or housing financial activities without the certificate of registration, you will say yes. And you will specify what activities. Whether the company is a CIC, so no. Whether the group has more than one CIC, based on the given information, you need to report that. Clear? So that is about the certificate of registration or the reporting under the CAR. Okay, very good question, because it clears out the understanding from where the registration requirement is coming into the picture. Okay. One again, very good question. Very good question. I will take up now. Cora Capital Limited, a NBFC classified under the scale-based regulation framework, is required to maintain capital ratio of 15% of aggregate risk-weighted assets and risk-adjusted off-balance sheet items. The following data is there for the tier 1 and tier 2 capital. What is the following data? Own funds, investment in shares of other NBFC, perpetual debt, preference shares, revaluation reserve, general provisions and loss reserve, hybrid debt capital instrument, subordinate debt, and risk-weighted average assets or risk-weighted assets. So accordingly, what is the question? The question is, it is neither an NBFC MFI nor engaged in lending against gold jewelry. Calculate tier 1, tier 2 capital and check whether it meets the minimum capital adequacy requirements of 15%. Okay. So take a minute, read this question, and then tell me, what do you think about this particular question? What will be the answer? So, and if you, we will go to also a particular part of the study material to discuss the answer. So, okay. If you want to see the answer and the understanding is on the page number 14.92 of your study material, which is prudential norms. Okay. Over there's something called capital requirement. Now, capital requirement, basically, NBFC is required to maintain some level of capital. And that capital is divided into two categories, tier 1 capital and tier 2 capital. So the calculation of the tier 1 and tier 2 capital basically is on the given formula. So you need to understand what is the formula, how to calculate tier 1 and tier 2 capital, and accordingly you need to answer the question. Also, for your understanding, I will also show you the calculation of the tier 1 and tier 2 capital, which is given in the new regulation. Okay, new one. So accordingly, we will be able to understand that, okay, the tier 1, tier 2 capital requirements. Now, if I talk about tier 1 and tier 2 capital, first of all, understand one thing. Tier 1 capital for base layer is a bit different than the middle layer. Why? Because there is one item which we are not required to include in the base layer versus we are required to, include in the middle layers. So if we are talking about base layer, over there we are not required to include few things, or one particular item rather, not few things, one particular item, which is the perpetual debt instrument. So accordingly, that will not be there in the tier 1 capital. Okay. Now, what is the new regulation says for the tier 1? So I'll talk about elements of tier 1 capital. So elements of tier 1 capital as per the given regulations, okay, is as follows. So what it says is that the tier 1 capital of a NBFC BL, okay, primarily lending against gold jewelry, and a NBFC ML shall comprise of, so BL, which is lending against gold jewelry, this should be together, not only BL plus lending against gold jewelry, or ML. Own funds reduced by investment exceeding in aggregate of 10% of own funds, by investment in shares of other NBFCs, investment in shares, debenture, bonds, outstanding loans of companies in the same group. Okay. So own funds reduced by, so you have a own funds, you need to reduce that own funds, okay, in aggregate, okay, by investment exceeding 10% of that. So whatever your investment is there, let's say for my investment is investment in shares of other NBFCs, plus investment in group company. Okay, whatever this amount comes, let's suppose this amount is a X amount. This is a X amount. Then if this is equal to X, now you need to check whether what is the amount which is exceeding 10% of own funds. So X minus 10% of own funds. Okay, let's say that is equal to Y. Now this Y is required to be reduced. Okay, this Y is required to be reduced from your own funds. So own funds reduced by the following investment exceeding 10% of own funds. So I need to now reduce this Y amount, which is in excess of the 10% of the own funds, from the own funds to get the tier 1 capital. Then I need to also consider the perpetual debt instrument issued by a non-deposit taking NBFC. Okay. To the extent does not exceed 15% of the tier 1 capital as on March 31st of the previous financial year. So I need to go back to the previous financial year, whatever 15% it is, like tier 1 capital is there, 15% of that, and reduce it from the current tier 1, current year calculation of the tier 1 capital. If it is NBFC BL without lending against gold jewelry, plain BL, okay, without lending against gold jewelry, okay, in that case PDI, that is the perpetual debt instruments, are not included at all. So if it is a middle layer, include. If it is a base layer and without lending against gold jewelry, you will not consider perpetual debt instrument. Clear? Any doubt? Okay. If no doubts, then this is the first of all tier 1 capital calculation. And then comes the tier 2 capital. This is the tier 1 capital. Okay. Now comes the tier 2 capital, which is again we need to understand from the perspective of this only, base layer, middle layer. So when I talk about tier 2 capital, so tier 2 capital, basically I need to, accordingly consider. So I'll show you the tier 2 capital. So the tier 2 capital will include your preference shares other than those which are compulsorily convertible debentures, revaluation reserves which are discounted at the rate of 55%. Okay. That means at a discounted rate of 55%. Discounted rate. General provision, okay, which is again to the extent of 1.25% of risk weighted average assets. Hybrid debt instrument, subordinate debt. Again, subordinate debt earlier was with respect to the maturities. Similarly, now it is there. Based on the maturities, you need to discount that subordinate debt. PDI, that is a perpetual debt instrument. Now, perpetual debt instruments which were in excess of tier 1 capital, like if there was something perpetual debt instrument which you did not consider in the tier 1 capital for middle layer and base layer with lending against gold, okay, jewelry, then otherwise it for the NBFC base layer PDI is not relevant at all. Okay, this is your calculation for the tier 2 capital. Now let's go back to our question. We have own funds, we have investment in shares of NBFCs and in group companies exceeding 10% of own funds. You have directly given that amount. Perpetual debt instruments, preference shares, revaluation reserve, general provisions, hybrid debt instruments, subordinate debt, and risk weighted assets. Okay. Now, accordingly, you need to calculate first tier 1 capital. Tier 1 capital, own funds. Then you need to reduce the investment in group companies in excess of 10%, and then perpetual capital, perpetual debt, instrument. If it is base layer, if it is middle layer or base layer with risk weighted, base layer with the gold jewelry lending against that. Now, is it a base layer NBFC or a middle layer NBFC? Is this a base layer NBFC or a middle layer NBFC? Anyone? That's where your answer will bit differ. Okay. Anyone? Okay. Now, here in the given scenario, if my net assets, see again, my asset size determines whether it is a base layer or a middle layer. Remember, asset size more than 1,000 crores. So here my risk weighted average assets are 8,000 crores. So I will consider this as a middle layer NBFC. And accordingly, I will perform my calculation. So in this particular scenario, what I'll do is, first of all, I will start with my own funds. Then I will reduce the excess, like, exceeding 10%, exceeding that particular amount. So own funds less investment exceeding 10% of own funds. So the directly which is given exceeding 10% of own funds, 150. Then I will add perpetual debt instrument. But again, with the perpetual debt instrument, what you are required to add? You are required to add to the 15% of the tier 1 capital of previous year. Do you have a tier 1 capital of previous year in this question? Do you have a 15% of tier 1 capital of previous year? Yes, no? So in this scenario, you need to assume that, okay, the previous year capital, again, tier 1 capital was there, and accordingly, you need to consider the entire 120. I will consider, assuming it is more than the 15% of tier 1 capital. Sorry, less than 15% of the tier 1 capital. So whatever amount will come over here will be my tier 1 capital. Okay, so it will be 970 CR. Now, after getting this particular amount, of 970 CR as a tier 1 capital, I need to proceed and calculate the tier 2 capital. So tier 2 capital, what we saw, the elements of the tier 2 capital is nothing but, after getting the tier 1 capital, you need to perform the following adjustments. Preference shares, revaluation reserve at the discounted rate, general provisions, hybrid debt instrument, subordinate debt, and perpetual debt instrument, which was not counted earlier. So let's go back to our question, and I need to add all those things. So preference shares, ATCR, revaluation reserve at a discounted rate of 55%. Okay. And what I'm required to do with the revaluation reserve? I'm required to add that revaluation reserve. Okay. So preference shares, 80. Then revaluation reserve at a discounted rate of 55%. 200 into 55%. Then general provisions and loss reserve. Now let us see what was there with general provision and the loss reserve. So general provision and the loss reserve, okay, to the extent they are not attributable to the, any diminution in the value of identifiable specific assets, but to the extent of 1.25% of risk weighted average asset. So general provision only to the 1.25% of risk weighted average assets. So you have a risk weighted average assets. If I multiply this 8,000 into 1.25%, whatever amount will come. If my general provision is, more than that, I need to restrict my amount to that percent. So 8,000 into 1.25%, which is 100. Okay, which is coming to 100 CR. Now, maximum allowed amount is 100 CR. Maximum allowed. Mine is 50 CR. So I will take it 50 CR entirely. Hybrid debt instrument. So what was with respect to the hybrid debt instrument? You can add it. You can include the hybrid debt instrument. Okay, of 90 CR plus subordinate debt. Here there is no, maturity is given. So I will consider entire amount. So 90 plus 140. Then there is something more I need to add. So if there is an investment in the share companies or other companies, which was, basically not included in tier 1 capital, I need to see what was that amount plus perpetual debt instrument, which was not included in the tier 1 capital. So if there is something which is not included in the tier 1 capital, can I add it in the tier 2 capital? But that is with respect to only perpetual debt instrument. So is there anything which I have not added into the tier 1 capital in perpetual debt instrument? No, I took the entire amount of 120 CR. So there is nothing further left to add in the tier 2 capital. So accordingly, my tier 2 capital from here will come to so let me do a calculation. 80 into like 200 into 55% plus 80 plus 50. So 110 plus 80 plus 50 plus my 90 plus 140. The amount will come to 470. That is your tier 2 capital. Now, what is required is your tier 1 capital and tier 2 capital should be 15% of risk weighted average assets. Tier 1 plus tier 2 capital. So what is my tier 1? 970. Okay, so 970 plus 470. What is coming total? 1440. Okay, it should be more than 15%. If I talk about 8,000 into 15%, that is comes to 1200. So minimum required 8,000 into 15%, which is 1200. But my minimum capital adequacy ratio is 15%, which is there. My tier 1, tier 2 is more than that, 14,440. As a result, I am meeting the minimum capital adequacy requirements of 15% of risk weighted average assets. So in given answer, you need to say, okay, what is tier 1? 970. What is tier 2? 470. Okay, whether you are meeting, yes, we are meeting. And with the help of this calculation, you need to demonstrate this entire answer. Clear? Any doubts? Okay. So very good question, because this help us to understand the entire calculation, that how you calculate tier 1, tier 2 capital in a given scenario. Okay. And based on this, you will be able to understand the calculation of tier 1, tier 2 capital, which is there. Okay. If no further doubts, let me proceed further to a very good question I have. So this is an MCQ. Very good MCQ. Mr. Suraj reported under clause 3 A3 of Master Directions of NBFC Companies Auditor Report Reserve Bank Direction 2016 that Alpha Limited is eligible to hold its COR under Section 45 IA of RBI Act. So it is not eligible to hold. They reported that. Not eligible to hold COR. Fine. As during the year, the net owned funds went below the minimum required limit. Management of the NBFC had a different opinion that the certificate pertains to the net owned funds from the statutory auditor is required with reference to the position of the company as at 31st March, not based on the each month's position. Kindly guide with Mr. Suraj with respect to the reporting requirement under master direction, and these are your given options. What I suggest is read these options, take a minute, and then tell me what do you think. Okay, read these options, because we will be now discussing something with respect to what auditor is required to report apart from CARO with respect to the NBFC. Very good part. Quickly. So here we will be discussing about the requirement for reporting by the auditor. Okay, I hope you read the MCQs options. I will read the MCQs. I'll come to the MCQs. We will discuss in detail. But now, for a minute, let's understand here what is the reporting requirement for the auditor. See, when I talk about reporting requirement other than the CARO for the auditor, let's come to the page number in your study material. Okay, page number 14.107. And over there, you have point number 7, auditor's duty. Now, auditor is required to comply with the specific RBI directions which are issued for the reporting. And there is no change as of now in those directions. Remember that. So when I talk about directions with respect to non-banking financial company, auditor's report, Reserve Bank of Direction 2016, they are perfectly as it is. They are the 2016 direction. As per this direction, there is a reporting requirement. Okay, there is a reporting requirement. Auditors are required to report few things. What are those things? First, and this report is done to the board of directors. So, what auditors are required to report? For all the NBFCs, irrespective of deposit accepting or categories. That means MFI, all those things, NBFC factor, okay. So irrespective of the categorization, deposit accepting, not accepting, whatever it is applicable to all NBFCs. And auditor to, rather than the auditor of all NBFCs, auditor of all NBFCs are required to report whether the NBFC was conducting non-banking financial activity without a valid certificate of registration. If the company is engaged in the business of non-banking financial institution defined in 45I clause A that we discussed, this one, this is the main one, business of non-banking financial institution, okay, and meeting the principal business criteria as laid down in this circular, okay, has obtained the certificate of registration or not. So means if you are doing any business of NBFC and you don't have a COV certificate of registration, or if you are meeting the principal business but still you don't have a COR, report. In case company holding COR issued by the RBI, whether that company is entitled to continue hold such COR in terms of principal business criteria. That means whether you are meeting the 50-50 business criteria as at March 31st of the applicable year. So at every financial year end, you are required to reevaluate. So reevaluation on 31st March. Again, then whether it is meeting the criteria of net owned funds laid down in the master direction, that is the scale-based regulations. Okay. And here there is one important thing that we need to understand. Every NBFC is required to submit a certificate from the statutory auditor that it is engaged in the business of NBFC. It is holding a COR. Okay. And as at the end of financial year, that is very important part. As at the end of financial year, okay. As at the end of financial year, it is meeting the position which is there. So a certificate from the statutory auditor reference to the position of that particular NBFC as at the end of financial year. So what is the scenario at the end of financial year for that particular NBFC? Whether the NBFC is meeting all these requirements at the end of financial year, that is 31st March. Not every month, not on continuous for the entire financial year. See, the movement can happen during the financial year, but what is the position as of the 31st March? So I need to report as on 31st March the position of the NBFC. Okay. So that is something is required to be done. In our question, if you see the option, the dispute is the auditor is saying that, okay, net own funds went below minimum required limit. That is during the year. Management was of the opinion that, okay, auditor is required to provide the certificate with reference to the position of the company as at 31st March, not based on each month's position. So auditor was saying no, I will see during the year. Management was saying no, see as at on 31st March. So options are: every NBFC shall submit a certificate from statutory auditor that it is eligible to hold a COR under Section 45 IA of the RBI Act. Such a certificate should be with reference to the position of the company throughout the financial year. That is option number 1. Option 2, every NBFC shall submit a certificate from statutory auditor that is eligible to hold COR under Section 45 IA of the RBI Act. Such a certificate should be with reference to the position of company as on 31st March. Something similar that we have seen till now, but let's go to the other option. Only NBFC MFI shall submit a certificate. Starting yourself is wrong. We saw all the NBFCs. So if you read throughout the year, financial year, it's wrong. Because only NBFC MFI, I said irrespective of the classification. That's why I said. So this is wrong. Throughout the year, wrong. We saw as on 31st March. So as of now, B is appearing correct. Let's see the D1. Every NBFC shall submit a certificate from its statutory auditor that is eligible to hold a COR. Such a certificate should be with reference to the position of the company as at the end of each month. Again, each month, wrong. So the correct answer is B, with reference to the 31st March. Clear? From where 31st March is coming? Any doubt? Very good question. Okay. Now let us take one more question. Again, very good question it is. And it is with respect to a similar topic that we have seen till now. It is with respect to some calculations on the capital requirement. And it was asked in the exam itself. Okay, just a minute. So the question is, Instance Finance Limited. Instance Finance Limited is a non-banking financial company, primarily engaged in providing loans to small businesses and individuals. Now, here we are talking about BN. Remember that. As per audited financials for the year ending 31st March 25, the following information was observed. Instance Finance Limited has an aggregated risk-weighted asset base of 1,000 crores. The company has reported tier 1 capital of 130 crore, which includes 15 crore raised through perpetual debt instruments. Instance Finance has an investment in shares and bonds of other NBFCs totaling to 10 crore, which amounts to 12% of its own fund. The company's primarily business involves lending against gold jewelry, with such loan comprising of 60% of its financial assets. You are required to, okay, evaluate whether the instance finance complies with the minimum tier 1 capital requirement as per the RBI prudential norms. Discuss the treatment and impact of perpetual debt instrument in the tier 1 capital, and analyze the adjustment required in the tier 1 capital for instance finance due to its investment in other NBFCs. Okay, a good question, but on a similar thing that we were asked earlier. Now, first of all, tell me, what is the question number 1? Evaluate the minimum tier 1 capital requirement as per the RBI prudential norms. So what is the minimum tier 1 capital requirement for instance finance? Anyone? Minimum tier 1 capital requirement. No? Okay. So again, I will take you to the regulations, which are the, okay, which provides what is the tier 1 and tier 2 capital requirement. So we will discuss capital requirements for the NBFCs tier 1 and tier 2. So what it says, okay, these are the following minimum capital requirements on an ongoing basis. Ongoing basis. That is, an NBFC primarily engaged against the lending against gold jewelry shall maintain minimum tier 1 capital and a capital to risk weighted average ratio, which is CRAR ratio of 12% and 15%. So minimum tier 1 is 12%, CRAR 15% for lending against gold jewelry. Okay. So lending against gold, minimum tier 1, 12%, CRAR 15%. The tier 2 capital of the NBFC at any point of time shall not exceed the tier 1 capital. And how do you calculate CRAR? The formula is given that the tier 1 plus tier 2 divided by risk weighted assets is your CRAR percentage. Okay. Now this is for the lending against gold jewelry. If it is a middle layer, so minimum tier 1 will become 10%. Okay. And again, how you need to calculate tier 1? Tier 1 capital divided by risk weighted. If it is a NBFC middle layer, okay, so CRAR should be 15% and tier 2 should not exceed 100% of tier 1 capital. And again, then for upper layer, there is something called a common equity tier and different requirements. We will not go into that as of now. But we understood what is the minimum required for the tier 1 for the NBFC lending against gold jewelry. Clear? This is the basic that we have understood. Straightforward, basic requirement. What is required to be included? Now, let's go back to our question. So, our question, sorry. Yeah. What was it? Evaluate whether the instant finance complies with the minimum tier 1 capital requirement as per the RBI prudential norms. So tier 1 should be, now we understood what is there, and the CRAR we understood. Tier 1 should be 12%. Now, how you need to calculate 12%? What is given over here, tier 1? So tier 1, it is given that your tier 1 capital is, sorry, 150 crores, which includes the perpetual debt instrument of 15 crores. Now, what was the requirement with respect to the perpetual debt instrument? So with respect to the perpetual debt instrument for NBFC base layer, primarily engage in the lending against gold jewelry, perpetual debt instrument. Okay. You are required to include in your tier one, but to the extent it does not exceed 15% of the tier one of the previous year. 15% of the tier one of the previous year. So it says that tier one capital includes 15 crore raised through the perpetual debt instrument. Now, do you have a tier one capital of the previous year in the given question? Do you have a tier one capital with respect to that what is in exceeding of the 10% in the previous year? Sorry, what is exceeding your tier one capital of the previous year? Yes, no, you don't have. Okay, so you can assume that it includes it is not exceeding that limit. So okay, so 15 crore I will include. I will assume that it is not exceeding 15% of tier one capital. I will assume that over here, and accordingly I will calculate that I will include that 15 crores. Then what I need to do is group investment again exceeding 10% of own funds, that is required to be removed. There are two things now. Here you have a 10 crore amount given, which is 12% of own funds. So you can identify what is own funds. Okay, if basically 10 crores is given, which is your 12% your own funds, then you have a own funds which is you can get it what is excess of 10% of own funds. So by the reverse working, basically, so 10 crore is your 12%. So how much will be 10%? Simple. Divide by 12. So it will come to 8.33 kind of. Okay. And accordingly, anything excess of that will be disallowed. So what will be excess of that? That is 1.67. So less 1.67. I'll just remove as of now this one. Okay. So I will remove, this is excess of 10% of own funds. So whatever your amount will come now, that is 130. I will add to that. Sorry. So 128.33 is your tier one capital. Here, any doubt? That is your tier one capital. Okay. Now, tier two capital. Tier two capital. Now we need to, second question was given is, sorry, we need to understand what is second question. Second question is discuss the treatment and impact of the perpetual debt instrument in the calculation of tier one capital. NBFC primarily engage in lending against gold jewelry. So again, based on the given requirement, if it is NBFC primarily engaged in the gold jewelry, the tier one capital will include the perpetual debt instrument, but where it does not exceed 15% of the aggregate of tier one capital. So that is the requirement of the perpetual debt instrument. So you need to write that thing. Okay. Then analyze the adjustment required in the tier 1 capital for the Instance Finance Limited due to investment in other NBFCs. So we just now saw that in excess of anything, like in excess of investment exceeding 10% of own funds has to be reduced from tier 1 capital. So if you have an investment in shares of other NBFCs and investment in shares and securities of the same group, which is exceeding 10% of the own funds, reduce it from the tier 1 capital to that particular extent. And that will be the answer of the third question. Now, are you meeting the minimum tier 1 capital requirement over here? So what is the minimum tier 1 capital requirement? We just now saw the minimum tier 1 capital requirement in this scenario was 12% of the risk-weighted average assets. So risk-weighted average asset is 1,000 crores. So 12% of that, 120 crores. Are you meeting the tier 1 with 120 crores? Answer is yes, we are meeting. The 120 crores, our tier 1 capital based on the calculation is more than 120 crores. So we are meeting the requirement of the tier 1 capital. Clear? Any doubt? Any doubt till now? If you guys have a doubt, you can ask your doubts in the query part, and accordingly it will be answered. Okay. Now that was your calculation for the tier 1 capital and for the base layer with respect to the engaged in the primarily providing loans to gold jewelry and everything. Okay, if it is not providing loan against the gold jewelries, if it is not providing loan against the gold jewelries, if it is involved into directly, like say, providing loans to small businesses, as of now, forget about lending against the gold jewelry. If we forget about that, in that case, we need to remove the perpetual debt instrument entirely because it is not available for the BL. Your tier 1 capital will reduce by that. Okay. So in that case, your tier 1 capital will be something different. What will be your tier 1 capital? Your tier 1 capital will be, if I assume this is not the part. For time being, if I ignore this. So what will be the scenario is, I need to remove the 15 crores entirely from 130 crores. Okay. So I'll just give you an answer over here. For basic NBFC BL, not gold jewelry or gold loans. Okay. So I will take my tier 1, 130. I will reduce perpetual debt instrument of 15. Okay. And I will again check whether, here in this scenario, 130 minus 15 is, let's say, my 115. Whether it is matching with the, you can say, the minimum required. What is minimum required? 120. Okay. 120 is required. So is it matching with 120 or not? I need to answer from that perspective. Secondly, some might also take that, sir, you have a own funds given in the question. Can we do a reverse working and get the own funds, and accordingly we can work on that? So I have a 10%, 10 crores of amount, which is 12% of own funds. Can we do a reverse multiplication and get 100% of the own funds? Yes, you can do that. You will get an answer of 83.3. crores. Can we take, sir, this own funds and do the addition and subtraction? So let's say, for example, reduce preference shares or investment basically in the group companies. So investment in group companies. Okay, less. Again, some may ask, sir, can we reduce the perpetual debt instrument over here in excess of 10% of own funds? Okay, can we do that? But if it is a base layer, then you are not even required to, consider perpetual debt instrument. So earlier it was included. That's why we were reducing. But here perpetual debt instrument are not included in own funds. So I will consider zero, and investment in group companies in excess of own funds, in excess of 10% of own funds, 1.67. So the answer I will get is 81.67 CR as a tier 1 capital. Clear? Any doubt? So again, you can work upon both of the scenarios the way you want. Okay, there are this alternate answer is also possible in this particular scenario. Okay, if no further doubts, then what we do is, let's take a quick 10-minute break. This was the NBFC. We discussed a good amount of questions on the NBFC, plus on the amount of, what is there with respect to the tier 1, tier 2 capital and what are the requirements. Now after the break, let's proceed to the next chapter, which is chapter number 14, unit 1, which is the audit of banks. Okay. Let's take a quick 10-minute break, and after the break, we'll gather back and continue our unit number 1 and questions on that. Thank you. Yes. to proceed to the unit number 1 of the chapter 14, which is special features of audit of banks. Okay, again, we will take some questions and accordingly we will solve the answers. Just one thing before we proceed to the banks and, with respect to the NBFC part. See, whenever you are referring to the suggested answer or any of the previous material, remember in NBFC, there are certain areas which have changed with respect to the year part. For example, NPA. Okay, so NPA calculation was something with 150 days for 2024, then 120 for 25, and then 90 for the 26. Now it is 90 for the 20 after 2026. Okay, then for this 180 like referred, which was reduced to 90 days to 2026. So you need to take care of that okay, according to the question which is asked, according to the glide path, you need to answer the question, the provisions which are applicable. Plus, if you go to this particular update that is also there in the RTPs, okay, like on tier 1 capital, NBFC primarily engage against the lending against the gold jewelry that we saw. Okay, minimum tier 1 12% on the risk balance risk on the adjusted value of the aggregate risk weighted asset items. Plus there is accordingly all the things which are required to be taken. Then again you have a addition to the ROU assets and other asset definition which is given. So you need to take care of these amendments. Okay, and accordingly basically you need to provide the answer to a questions. If there's a change in limit, if there is something change, then in that particular case you need to understand, okay, what is the change, and accordingly you need to provide the answer. Okay, so understand from that perspective and then you answer it. Just don't directly refer the answer which are given of the previous year's question, because it may be different for that particular period. But now if you want to answer as per your year, it might have changed the way it changed in the taxes. Okay, similarly, if there is a change in the limit, you need to answer accordingly. So just one small thing you need to take care of when you are answering a question on the NBFC, make sure you are taking the updated limits. Okay, now let's proceed to the audit of banks. Again, I have a good collection of the questions. Let's see those good collections of the questions, and accordingly what we will do is we will discuss the answer of these questions and understand the topic also. So the first question is, CAJ is a statutory auditor of a branch of nationalized bank. During the audit, he's also focusing upon verification of current account and savings account maintained at the branch. Suggest a few audit procedures he should follow. Pretty simple, but again requires an understanding of the audit process of the account verification. Like how do you verify the current account and saving accounts? Okay, so when you have to verify current account and saving account in a particular bank, what you will do? Anyone? If you have to verify current account or saving account, what things you will focus upon? See, now when I talk about account related, so think of the process from start to end. Okay, what basically activities are performed when you talk about opening of an account, opening of a savings account, opening of a current account. Okay, what things are involved in that, accordingly what procedures are performed, the KYCs and all those things. You need to focus on all those things, and based on that you will be able to answer, okay, what are the activities that the auditor should undertake in order to verify these accounts. So if I have to answer this, you have to first of all see, again, apply on a sample basis. Take on the sample basis, you need to apply for the KYC, like in whose name the account has been opened. Verify the individual balances in the account. Check the interest calculations on those accounts. You need to verify the current account and saving accounts. So from the KYC to the interest to the balance confirmation, periodic. Okay. You need to see whether there is a debit balance in the current account. Is there any, they should not be netted out on the liability side, but appropriately should be headed under the head of advances. Then you need to see if they are dormant accounts or not, because dormant accounts have a different criteria. So accordingly, you need to report on like how auditor is required to verify these accounts. So let us see the answer. So answer includes, as I said, verify on the sample basis current account and saving account opened during the year and their adherence to the KYC norms. So the KYC norms that are required to be followed. Verify whether if they are open in the name of individual, HUF, some approved institutions. Okay. Now remember that saving accounts are not to be open for the businesses or profession concerns. Business transactions are carried in the current account, not in the savings account. Verify the balances. Okay, check the interest calculation. Okay, then you can obtain for balance confirmation. Now ensure debit balances are not netted out. As I said, you verify for all the inoperative accounts, how, for what period they are inoperative, and accordingly whether they are classified as inoperative or dormant or not. Nowadays, there is a requirement of annual KYC in certain accounts. So whether this annual KYC has been complied with or not. So all these things you need to report accordingly when you are reporting for the accounts. Clear? Pretty straightforward question. Second question. You have been appointed as a concurrent auditor of branch of Silver Bank Limited, which primarily deals in foreign exchange transactions. During the audit, you noted discrepancies in certain inward and outward remittances, as well as unusual fluctuations in nostro account balances. What audit procedures would you implement to verify the accuracy and compliance of the foreign exchange transactions of this branch? So here you are required to report with respect to the foreign exchange transactions of this branch. Okay, so whatever foreign exchange transactions are being undertaken with respect to the nostro accounts, balances, or with respect to similar accounts, you need to verify their accuracy and the compliance with the regulation. So tell me what procedures you will undertake for that. Anyone? What procedures you will undertake for that? Now, see, again, whenever these kind of question comes, you need to understand from the perspective of that from start to end, what are the processes involved, and accordingly you need to answer that particular question. Okay, so you need to first understand what are the processes involved in that. It may be, when I talk about foreign exchange transaction, so what kind of foreign exchange transaction? Foreign bills. Okay, then you need to check for FCNR and non-resident accounts, their debit and credits. You need to see whether debits and credits are permissible under FEMA rules or LRS. Okay, check for inward outward remittances, whether they are proper or not, whether they are with whether when approved by a ID banker, whether it is supported by the appropriate documents or not. Then you need to examine the cancellation and extension of the forward contracts for the purchase and sale of foreign currency, whether they have been duly authorized. Then you need to see balances in the nostro account in different foreign currencies, whether it is within the prescribed limit, because there are prescribed limit for that. Okay. Then there are some NRE accounts. non-resident external rupee accounts or non-resident accounts, you need to see how the transaction between the NRE and the FCNR accounts and other NRO accounts is happening. NRO is a non-resident rupee account. Okay, so you need to understand how transactions are happening between those. Then you need to examine, is there any kind of oversold or overbought position with respect to the foreign currencies. If there is a dealing room operation, then there are dealing room operation guidelines by the RBI, whether those guidelines are being followed or not. Okay, you need to perform the reconciliation between Nostro and Vostro accounts for the transaction and balances. So all these things, whether these are being complied with or not. So accordingly, you can, then appropriately answer whether your transactions in foreign currencies are being undertaken appropriately or not. So if you want to see answer for this question, come to page number 14.67 of your study material. So over there is a table given which talks about type of activities to be covered as a part of audit. Okay, and in that there is a foreign currency activities, means foreign exchange transactions. And again, so check for foreign bill negotiated under letter of credit, check FCNR and other non-resident account. Okay, then check whether the inward-outward remittances have been properly accounted for. Examine extension and cancellation of forward contracts, as I told you. Ensure balance in Nostro accounts. Oversold, overbought positions, as we discussed. Guidelines to the dealing room operations. And verification and reconciliation of Nostro accounts. Now, if you want to see these kind of accounts, again, these are also given in your study material on page number 14.50. If you come to 14.50, I'll give you a brief understanding of the different kind of accounts within the foreign currency. See over here. Now, this is something with respect to the accounts in the foreign currency. Foreign exchange related account, you can say that. Now, one is a foreign currency non-resident deposit accounts, FCNR accounts that we talk about. Okay, it is in the form of fixed deposit only. It is very important to understand these things, because then only you will be able to understand what to audit and what is allowed, what is not allowed. Then there are NRE accounts, non-resident external rupee accounts. There are NRO accounts, non-resident ordinary rupee accounts. NRE may be opened by a non-resident Indian or in a person of Indian origin, PIO. NRO may be opened by all non-residents. Okay. Again, there are some transactions which are permitted under the NRE account and NRO account. What kind of transactions can be undertaken in, NRE and NRO account? So not all transactions can be undertaken in both accounts. Okay. These accounts are for specific purposes. Basically, if I talk about NRO account, these are the managing Indian-based income for the non-resident. When I talk about NRE account is basically managing the overseas earning. So you can understand, that's why it is external, something related to overseas. This is ordinary, means something related to domestic. Okay. Again, these are opened by the non-resident. So NRO, NRE accounts which are there. Again, there are limits in these accounts, NRO accounts or NRE accounts. And as per the FEMA provisions, you need to see what is the permissible limits under the LRS for the current income, capital account transaction, current account transactions, all those things come into the picture. Okay. So accordingly, you can audit the foreign exchange transactions of the branch. Clear? Same items that we saw earlier, which are mentioned over here. Again, same on page number, I think. Just a minute. Let me write a reference for you guys over here. Page number 14.67. Okay, foreign exchange from study material. Okay, let us see one more question. Very good question. Claim Limited is enjoying cash credit facilities sanctioned from Ludhiana branch of DDL Bank for 300 crores. However, for practical considerations, various sublimits have been fixed for the borrower company for operation at the Amritsar, Patiala, and Rajpura branch of the same bank. The manager of the Amritsar branch notices that there are no credit transaction in sublimit accounts being operated at Amritsar branch for more than 90 days as on 31st March 2025. Discuss the approach of CA Krish, statutory branch auditor of Ludhiana branch of DDL Bank in the matter of the asset classification of the above borrower account, and also discuss the consideration for classifying said account at the Amritsar branch. Now here we are talking about classification. Okay. Classification for a particular account. Now there are no credit transactions in a cash credit facility. Now first of all, you need to understand how the classification works. Okay. Then on the basis of that, you will be able to answer that, sorry. Yeah. Then on the basis of that, you will be able to answer that whether this particular classification, is appropriate or not. So first of all, let's understand the classification of cash credit facilities. Anyone, how cash credit facilities are classified? Anyone? Okay. So in case of cash credit facilities, understand there is permissible that sometimes the customer is sanctioned a cash credit limit at one branch. Okay. But there is an overall limit at other branches also. And there is a limit fixed for each and every branch. So there is an overall limit and there is a sublimit which is given. Now, coming to the determination of the status of the NPA. Now, here we are talking about NPA of this cash credit facilities. Okay. In order to understand the NPA classification, you need to determine at the limit sanctioning branch. So, whichever branch is sanctioning the limit, over there you need to understand what is the NPA classification, not by the each other branches where there's a sublimit. Understand that. So I have to review the limit. Yes, limits are required to be reviewed, but at a branch where it has been approved, not at the other branches. So if there is a particular branch where there is a limit has been given, so that particular branch, I need to see what is the limit over there and what is the NPA categorization over there. I am not required to go for the all other branches, okay, where the sublimit has been assigned. As a result, the standalone position of more than 90 days, okay, there is no credit transaction on 31st March 2025 at a Amritsar branch or any other branch. If it is not a main branch, will not be relevant. Okay. So what is the main branch over here in the given question? Okay. So it is a Ludhiana branch. Now, Amritsar, Patiala, and Rajpur, they have a sub limits. As a result, whatever position is there at the Ludhiana branch is a prime position for me, for NPA. So the operating of the Amritsar branch and the position at the Amritsar branch is irrelevant. As a result, I am not required to report anything, or I am not required to consider anything at the Amritsar branch. My focus should be at the Ludhiana branch. Clear? Any doubt on this? But there is something I want to discuss further over here. Let's come to the page number 14.36 of your study material. Yeah. See, 14.36. What we are looking over here is, this is the area which is basically kind of, you can say, one of the important area where we are looking for the, you can say, asset classification. Okay. Now, first of all, this very important point, asset classification to be borrower wise, not facility wise. Now, what is this? It says that if a particular facility of a particular borrower becomes NPA, the other facilities or the other lendings to that same borrower will be classified as an NPA. For example, let's say a particular borrower has a loan, cash credit, or personal loan, term loan, all these things. If the NPA, if a particular term loan is classified as an NPA, all the facilities of that borrower will be classified as an NPA, irrespective of whether the actual NPA has occurred or not. Okay, so the asset classification works on a borrower wise. If a single facility of that particular borrower is classified as an NPA, all the facilities of that particular borrower will be classified as an NPA. So that has to be ensured that all the facilities granted to by the bank to the borrower should be treated as an NPA. In our question, we were talking about branch level, not the facility level. So when it comes to the borrower versus facility, you need to select borrower. When it comes to the branch limit versus sublimit, this concept will not be applied over there. I need to see branch overall limit and the classification at the branch limit, not at the sublimits. So some of the students get confused between this topic. Sir, we have to see borrower wise. So if at the one place it is NPA, I need to consider everywhere NPA. No. So both are different. Understand that. Clear? And accordingly, you need to see whether a particular account is an NPA account or not. So let's go see the answer. So based on a customer is sanctioned a credit limit at one branch, and to utilize such overall limit, sublimits is fixed. In such a case, the determination of the status of account as an NPA or otherwise should be determined at the limit sanctioning branch and not by each branches where the sublimit has been fixed. Okay, keeping in the view the total position of the operating of the account at all concerned branches would not be relevant basically. Okay, hence, as a result, the 90-day as of 31st March 2025 Amritsar branch is irrelevant. It is not required to be considered. I need to consider what is there on the main branch or the branch where the overall limit has been fixed. Clear? Any doubt? Okay. If no doubts, uh, let's proceed to a next question again on a similar line, but very good question. Park Bank Limited is reviewing cash credit limit worth of 3 crore of Manish Manufacturing Private Limited. During the quarterly review, the credit officer noted that the latest stock statement available was more than 3 months old. Based on the old statement, the drawing power calculations showed that the outstanding amount exceeded the permitted limit. Further, the sanction limits were due for renewal, but the renewal process has not been completed on time. However, the excess outstanding was only temporary and resulted from a short-term timing mismatch in the receipts. The officer is unsure whether the account should be classified as an NPA in the light of these observations. Evaluate the situation and determine with reasons whether the bank should classify the account as an NPA. Now, again, we need to understand whether this account should be classified as an NPA based on the drawing power calculation and the requirements over there. Okay. For that, let's again go back to the study material and we will see one important point. The drawing power calculation and then account with temporary deficiencies. These are the two important points that we need to understand. So what drawing power calculation requires to do, or what we are required to do to understand whether an account is an NPA or not. Okay. So first of all, when you are seeing the drawing power calculation, you need to understand that how that calculation is performed. Okay, whether the declared stock is covering the borrower's liability or not, whether is there any guarantee or not, how the calculation is done, whether there is a margin involved in the calculation or not, and everything we need to understand from that perspective. Valuation is done appropriately in the consistent manner or not. All these things we need to consider when we are looking at the drawing power calculation. So with respect to the drawing power, these are the few things we need to understand to identify whether the calculation is appropriate or not. Now, what is a temporary deficiency? Okay, temporary deficiencies are kind of deficiencies which are temporary in nature, which is kind of non-availability of the what you can say, drawing power due to latest stock statement, balance outstanding which is exceeding the limit temporarily, and non-renewal of the limits on the due date. These are the few things which specify kind of that there are temporary deficiencies in the account. Okay. Now, when I talk about temporary deficiencies, let's say non-availability of the stock statement or non-availability of the drawing power due to latest stock statement. But in that case, the drawing power should, the calculation of the drawing power based on the stock statement should not be 3 months older. Temporary deficiency is one thing. 3 months older is another thing. Okay. If it is 3 months older, you need to consider that as an irregular. And once it becomes irregular, then you need to count that particular part as an NPA. Again, if there are accounts where regular or ad hoc limits are provided and they are not reviewed within 180 days from the due date, they are required to be considered as an NPA. Okay. So 180-day limit is there to review the limits for the accounts. And if they are not done, consider them an NPA. Okay. In such a scenario, if let's go back to our question, what is happening is, so here There's a quarterly review. So latest stock statement was available. Okay. The credit officer noticed that the latest stock statement was available was more than 3 months old. Based on the old statement, drawing power calculation showed that the amount exceeded the permissible limit. Further, the sanction limits were due for renewal and the renewal process was not completed on the time. However, the excess outstanding was of the temporary nature. So there are two things coming into the picture. One, the stock statement is 3 months older. Second, outstanding is of the temporary nature. So there are two things running in the question itself. So you need to answer two things separately. Okay. So first thing for the stock statement. Now stock statement, which is more than 3 months old, this will trigger account as irregular. Now second part, which I talk about, excess of outstanding, but in temporary nature during timing mismatch, this is temporary deficiency. Sorry. And that will not make an account irregular. Okay. Yeah, stock statement will make an account regular. However, deficiencies due to temporary nature, they, are not kind of, which requires to make an account, you can say NPA, because this is temporary in the nature. Accordingly, you need to answer the question. So answer is, bank should not classify advance account as an NPA mainly due to existence of some deficiencies. Now, what kind of deficiency? Stock statement should not be more than 3 months older. If it is more than 3 months older, consider irregular. Okay. If there is an excess balance outstanding, okay, exceeding the temporary limit, again, you need to see why it is outstanding, exceeding the temporary limit. Now, account reflects irregularity due to reliance on the outstanding stock statement. Deficiencies are identified temporary. Okay. They do not justify the NPA classification. The bank must obtain the updated stock statement, but NPA recognition is not warranted because, see, your stock statement is outstanding, but the excess is because of the temporary deficiency. That's why I'm not saying it should be as of now NPA. Okay. So yes, you should obtain the stock statement, but it should not be classified NPA because of the temporary deficiencies. Okay. Again, similar. So identification of the or obtaining the stock statement is one thing, but you should not classify an advance account as an NPA because there are some deficiencies. If there are temporary deficiencies, fine, rectified, but do not classify that account as an NPA. Clear? Any doubt? Okay. If no further doubt, let's proceed to the next question. Again, very good question I have. During a statutory auditor of a Royal Bank Limited, a leading private sector bank, for financial year 24-25, the following issue emerged to a statutory central auditor. Royal Bank Limited acquired a commercial property in satisfaction of a loan defaulted by a borrower in financial year 16-17. The property was recorded at a net book value of the loan. The bank plans to sell the property in the next fiscal year to recover its dues. A legal dispute has emerged over the ownership of the property with a third party claiming partial rights. The matter is pending in the court. The management has not disclosed this dispute in the financial statement, but contains that a favorable court ruling is expected. The auditor reviews revealed that the property's fair market value is significantly lower. Based on the above facts, you are required to Identify specific audit procedures auditors should undertake to ensure compliance with the Banking Regulation Act. Under which head Royal Bank should record the above mentioned property, and suggest also other procedures that an auditor should focus upon. Okay. So take a minute, read the question, and then tell me with respect to this particular part, what do you think? What do you think? Okay. Now, for this particular question, okay, with respect to the property part, we need to understand where this asset is required to be classified and how this asset is required to be recorded. What are the provisions under the Banking Regulation Act for this kind of asset? And if you want to see, come on the page number 19.44 of your study material. (19.44) of your study material. See, first of all, let's understand what Section 9 says of the Banking Regulation Act. So, Section 9 of the Banking Regulation Act prohibits a banking company from holding any immovable property, howsoever acquired, that is, whether acquired by way of satisfaction of a claim or otherwise, for a period exceeding 7 years from the date of acquisition, except it is for the own use. Remember. So, Section 9 of the Banking Regulation Act, okay, requires that a particular banking company should not hold a property, okay, for more than 7 years, for a period exceeding of 7 years, howsoever acquired. So it is irrelevant, and we are talking about immovable property. That is a general rule. Now there are specific conditions that you need to verify when you are doing the audit. Let's say it is within 7 years. There are some specific things that we need to take care of when we are doing the audit of such other fixed assets. Okay. So what is this other fixed asset and what we are required to do this in other fixed asset basically? Now, when I talk about audit procedures, so there are two things which are given in your study material. One is over here, if you see, audit procedures for other fixed asset, and then there are other items also. So what is the audit procedures for the other fixed assets? So first of all, the procedure discussed above regarding the premises also applies to the verification of other fixed asset, that is physical verification and all those things. Now here we are talking about movable fixed assets, but again we need to see premises, and the premises part is given over here. Non-banking assets acquired in satisfaction of the claims. That is the other movable properties or other movable fixed assets. So other movable properties or tangible assets which are bank has acquired in satisfaction of the dues, like someone not paid the loan and the bank acquired that property, those have to be held for 7 years, not more than that. Now here you need to verify, what you need to do is verify relevant documentary evidence, terms of settlement, order of the court or award of the arbitration, how the property was acquired. Bank cannot directly go and take away the property. Bank can go for the debt recovery tribunal, or bank can apply for the arbitration or something else, or they may apply to the court. So in those cases, if there is a debt recovery tribunal order, okay, settlement order, or the order of the DRT, or there is an arbitration order, and if the property is awarded to the bank, then bank will acquire that property under that order. and you need to verify that documents. Verify the ownership is legally vested to the bank. If there is a dispute or other claim about the property, you should examine whether it is appropriate to record the asset or not. And accordingly, if dispute arise subsequently, not at the time of recording, but afterwards, okay, you need to examine whether a provision required as per the AS 29 provisions, contingent liability and contingent assets. Again, you need to ensure the compliance with section 9, that is a 7-year time limit. Okay, you need to also see that the acquisition of that particular property should be done at a net book value of the advance or the net realizable value of the asset acquired, lower of that. So lower of two things: net book value of advance or net realizable value of asset. Whatever is lower will be the value of the property. That will be recorded in the books of account. Okay, and accordingly you need to audit the property. Now in the given question, property was obtained or acquired in 1617. In financial year 24-25, bank, this particular part has emerged that bank plans to sell. That means they have still not sold this property. Okay, and there's a dispute on the property, which is matter is pending in the court. Now, what is the role of auditor? First of all, identify the audit procedures to undertake. So just now we discussed with respect to the compliance with the section 9, with respect to the ownership, with respect to the document, with respect to the provisions, all these things are required to be undertaken by the auditor. Second, under which head the Royal Bank should record the above mentioned property. So where the Royal Bank will report other assets. Okay, that is non-banking assets acquired in the satisfaction of the claim that we just now saw, the categorization. Suggests also other audit procedures the auditor should focus upon. So one was that identify specific audit procedure in compliance with the Banking Regulation Act. So here you need to write about section 9 of Banking Regulation Act. Okay. Here other audit procedures, so documentation, provision, okay, then cost, classification. Okay, so if I talk about, you need to say DPCC, that is documentation, provision, cost, classification. These are the 4 points that you need to see for the other assets, which is immovable property. Okay, so that is how you need to write the answer. See, this is the answer. First, we started with the section 9 of the Banking Regulation Act. Okay, then we specified, like the second question, it should be classified in the non-banking asset acquired in satisfaction of the claim in other assets. Third, other procedures like documentation, okay, provision, then you need to see recording of the asset, classification. Okay, so heading where the classification is there, heading immobile property, tangible asset. Okay, it should not be classified in any other area. And then the cost, lower of net realizable book value or advance of the all these, the way we discussed. So this is how you need to write the answer for this particular area. Clear? Any doubt? Any doubt? No? Okay. If no doubts, then I have a case scenario to discuss for you guys. A very good case scenario that we need to discuss. So case scenario is Rajesh and company have been appointed as a central statutory auditor of Goodworth Bank Limited and a private sector bank registered with RBI for financial year 23-24. Okay. Mr. Rajesh, the engagement partner, while examining the computation of DTL, demand and time liabilities, raised his suspicion regarding the inclusion and exclusion of the following. Net credit balance of the branch adjustment account, it was excluded. Amount received from the court receiver, inclusion. Amount received by ECGC by invoking guarantee, exclusion. Unaccounted inward remittance, inclusion. Net income tax provision, inclusion. Okay, let's see the questions and further case study. During the course of audit, Rajesh and company also observed that one of the large advance accounts of the bank had no recovery of principal or interest for past 15 months. The bank has not applied the NPA norms as well as income recognition norms to this particular account. When queried, the bank management replied that this account was guaranteed by the central government and hence norms were not applicable. The bank has not invoked the guarantee. Additionally, Rajesh and company was offered stock audit of a sister concern of Goodworth Bank Limited for financial year 23-24 and the branch audit of its Borivali branch for financial year 23-24 and the other branch for financial year 24-25 respectively. Based on the above questions, answer the following. Items at which serial number as aforesaid have been wrongly included or excluded from the computation of DTL, demand and time liabilities. Let me go back to that. Now you need to tell me what is correctly included and what is correctly excluded. And what is wrongly included and excluded. Anyone? What is currently appropriately included? What is not included? Okay. If you need the answer of this question, come to page number 14.21 of the study material. (14.21) of your study material. Over there is a point at the bottom of the page, which is while examining the computation of DTL, okay, specifically examining that the item has to be excluded from the liability as per the RBI guidelines. Some items are as follows. So these are certain items which are required to be excluded. What are these items? Paid up capital, reserve, any credit balance in the profit and loss account of the bank, amount of any loan account taken from the RBI, amount of refinance from Exim Bank and NBHP, NARBAD and SIDBI. That means if you see in this particular item, that is we are talking about loan from the banks, head bodies or, regulatory bodies, RBI, Exim, NHB, NABARD, SIDBI. These are the higher level institutions. So any refinancing or loan which has been taken from these higher, institutions is required to be excluded. So you can say paid up share capital plus reserve plus credit balance of P&L, because this is not the liability, but this is equity. Then we are talking about loan from, okay, higher institutions like RBI, Exim, National Housing Board, NABARD, and SIDBI. Okay, if these are the ones, then you can ignore, you can remove it from the calculation of the demand and time liabilities, because we do not count these as the liabilities. These are the amount of loan taken from higher institutions should not be taken as a demand and time liability. Then bill discounted by a bank with eligible financial institution as approved by the RBI. So if there has been discounting with the eligible financial institutions, then you need to exclude. Net income tax provision, exclude. Amount received from DICGC towards a claim held by bank pending for adjustments. So if there is advance amount received which is pending for adjustment, so basically you will show in advance or kind of liability because it is yet to be adjusted. So exclude that. Provisions which is shown on the liability side, okay, of the balance sheet, exclude that. Amount received from ECGC by invoking the guarantee, exclude that, because this will be adjusted against the loan which is given. So required to be adjusted. Against asset, and hence it is not a liability. Okay, understand that. What is a liability? That we have received something, we have to pay back. But this is something which is received in front of a guarantee, and guarantee was given in front of our asset. So it is required to be adjusted again in front of the asset rather than to be shown as a liability. Amount received from the insurance company for ad hoc settlement and pending claims against the judgment. Same. These three are the same that we discussed. These are required to be adjusted against the asset, not to be taken as a liability. Amount received from the court receiver. Same logic. Net unrealized gain or loss arising from the derivatives, because it's an unrealized. Okay. So not to be recorded as a liability. Income flows received in advance, such as annual fees or other charges which are not refundable. Why not to be included as a liability? Because not refundable. If it is something not required to be refundable, how it is a liability? Liability arising on account of utilization of limit under banker acceptance facility. Again, something with other banks and the higher bank working, to be excluded. Parts of amounts, recoveries from the borrower in respect of debt considered bad and doubtful. Again, this is for assets. So recovery in front of assets. Recovery for assets. Debts are asset for the banks. So if something has been recovered for the assets, why I will show as a liability? It is required to be adjusted. For timing, I may show in the liability, but not to be included in DTL calculation. Advance received in Indian currency against import bills held in the sundry deposit and pending receipt of final rates. Again, which is required to be adjusted in front of the import bills, requires is only pending for the adjustment, not to be shown as a liability. Unadjusted deposit or balancing lying in link with branches or for agency business like dividend warrants, interest warrants, refund of application money, kind of your amount you're holding for other people, like agency business, like where you need to issue the dividend, but you are still you need to issue interest warrants, but you need to still you need to issue that to certain people. Okay, application money in front of shares, okay, in respect of debentures. So some company received that, but you need to issue that back because of XYZ reason. Okay, as a result, those things are required to be refunded back. So it is not a liability kind of. So this is received, first of all, received on someone else's behalf, received on behalf of others, which is to be refunded. And hence, I will not say this is bank's demand and time liability, because it is received as an agency business on behalf of others, so not of bank. Then margin held and kept in sundry deposit for funded facility. Again, these are the margins, not something which we need to pay back on someone ask or on a particular time. It's not a demand or time liability. So accordingly, these are required to be excluded from liabilities as per the RBI guidelines. Now let's go back to our question. Okay, credit balance of the branch adjustment account excluded. Perfectly fine. It's not a demand and time liability. Amount received from the court receiver, inclusion. As I said, this is court received, amount received which is applied to be in front of the asset. So pending adjustment kind of thing. So this is wrong. Amount received from ECGC by invoking guarantee exclusion, appropriately correct. This was not required to be included. Unaccounted inward remittance received on behalf of customers. Again, it is not agency business. It is not agency business where it is interest, dividend, warrants, or all these things. Okay, it is something else. On behalf of customers, you have received unaccounted inward remittances that you need to apply for the customers. That is inclusion. Net income tax provision. Again, that is a provision, not a demand or time liability. That has been included, that has to be excluded. Okay, so 2 and basically kind of you can say 5, which is wrong. Now, point number 1. I said exclusion is correct. I said purposefully. Did we discuss that credit balance of the branch adjustment account in our list somewhere? Where we have discussed about the branch adjustment account? Over here. We are not. We have said for the higher institutions. I did not say that branch adjustment accounts. Again, I'm talking about higher institutions, not branch. Remember that. Very important. So branch adjustment, inter-branch accounts, those are required to be included. Okay. Inter-branch accounts will be considered. But here, if I say higher institutions like RBI, EXIM, or National Housing Board, or all these things, those are required to be excluded. So in our question, net credit balance of branch adjustment account, this is required to be included. Now, if you want to see this particular part, it is given on the page number 14.24 of a study material. Specifically, if we want to see this, see, the auditor should also particularly examine whether the balances in the branch adjustment account of a foreign branches have been taken into account in arriving the net balance of branch adjustment account. And then branch adjustment account, you need to consider for the purpose of demand and time liabilities. Okay. So branch adjustment accounts are required to be considered. And for the foreign branch also, you need to examine whether the balances of the branch adjustment account of foreign branches also being considered or not. So not only the local branches, but of the foreign branches also. As a result, in our question, the exclusion which is given is incorrect. So 1, 2, and 5 is incorrect. So question number 1, which items are wrongly included or excluded? That's where the included or excluded both is there. Item number 1 is wrongly excluded. Item number 2 and 5 are wrongly included. So if you see in our options 1 and 4, we never discussed 4. 2, 3, 5, 1 is missing. 1 and 3, 2 and 5 is missing. 1, 2, 5. So correct option is D. Second, whether the classification of the advance and income recognition by the Goodworth Bank is correct. Classification of income and advance of what? Of this particular part. Bank has not applied NPA norms on one of the loan, large advance account. Okay. where there has been no recovery of the principal or interest for past 15 months. So they have not applied the NPA norms as well as the income recognition norms, because they were saying there is a guarantee by the central government, which the bank has not invoked yet. What do you think? Is bank correct over here? We'll go to the options, but what do you think? So whether the classification of advance and income recognition by good bad bank is correct. So what bank is saying over here? So this particular account here, NPA norms were not recognized. Now, if you need to understand the answer for this, so basically, we need to understand the guarantee part, which is there. Okay, how the guarantee work in case of the advances or loan which are given. So for that, see, the principle and the kind of norm is that if there is any guarantee given on any of the particular advance or any of the particular loan, so to that extent of the guarantee, it is, if it is a central government guarantee, okay, then it is not required to be counted as an NPA till the time the guarantee is not be cancelled by the central government. So if you want to read this, page number 14.37 of your study material. Page number 14.37. Okay, government guaranteed advances. Now, there are two things. First of all, we need to understand. When the bank has not invoked the central government guarantee, okay, even though the amount is overdue for long, the basically it is not required to be calculated as an NPA. First of all, okay, you need to report the reasoning for the same, that why the bank has not invoked the guarantee. In LFAR, you need to provide that. Okay, you need to ask the bank, why you did not invoke the guarantee in this scenario. But till the time the guarantee is not invoked, it is not required to be classified as an NPA. It is classified to be as an NPA only when the guarantee has been invoked, okay, and it is not been cancelled or repudiated by the central government. Till that particular time, it will be classified as a normal only. Now here, if you see, if the guaranteed advance become NPA, where where the central government has cancelled the guarantee, or the not repudiated the guarantee, at that point in time, I will classify the NPA. Then for the purpose of income recognition, interest on such advance should not be taken to income unless it is realized. However, for the purpose of asset classification, credit facility backed by the central government guarantee, though overdue, cannot be treated as can be treated as an NPA only when the central government repudiates its guarantee, means cancel it when it is invoked. If it is not invoked, if it is not invoked, not cancelled, you cannot treat that as an NPA. Understand that. So it is to be treated as an NPA only when it is invoked and repudiated by the central government. Till that time, you are not required to treat that as an NPA. However, interest on such advance not to be recognized until and unless it is realized. So only asset classification will be impacted by the credit guarantee, not the income recognition. Remember that. So there are two things: asset classification and income recognition. So if I talk about asset classification, not to be counted NPA if backed by central government guarantee. I'll add a star mark because conditions apply. That is not invoked or invoked but not, you can say, kind of repudiated. Income recognition. For income recognition, treat as an NPA. That means do not recognize income until realized. That is, in simple terms, treat like NPA. So income recognition will be, counting this as an NPA only. Asset classification, it is not to be treated as an NPA. Let's go back to our question. Okay. Now here, what was the scenario is neither they did not apply the NPA norms as well as the income recognition norms. So NPA norms were also not applied. Income recognition was also not applied. So let's go back to options. So whether the classification of advance and income recognition by Good Bank, Worth Bank Limited is correct. Option is the bank is correct in not classifying advance as an NPA for provision, since the central government guarantee has not been repudiated, but interest income should not be recognized unless actually realized. You got the first option as your answer only. Bank is incorrect in not classifying the NPA. It is, the option is wrong. Bank is correct. Bank is correct in both not classifying the NPA and recognizing in the interest income. This is wrong. Bank should classify advance as an NPA only after 90 days. Wrong. So we got our answer of point number 10, that is the bank is correct in not classifying. Clear? Question number 11. Would auditor's conclusion change if the advance which remained overdue for more than 15 months was guaranteed by state government instead of central government? Very good question. Now we are talking about guarantee with respect to the central government and the state government. Will the answer change? Yes or no? So let's go back to our chapter and see what is written. See, if you see over here, what is written? You need to highlight this: central government guarantee. Central government guarantee. Central government guarantee. We never have specified state government. Have we? No. So it is central government. I also specified central government. So only central government. I will write over here. Only central government is covered, not the state government. There is no word. We just now saw. As a result, when we'll go to the answer, option is option number A. No, both central and state government guarantees are treated identically for the RBI IRAC norms. This is income recognition and asset classification, which is wrong. Yes, but only income recognition norms would change while asset classification would remain unaffected. Wrong, because there is no state government mentioned. It will change entirely. So it will change asset classification also. C. Yes, since the specific exemption from NPA is not available for state government guarantee advances, and the account would be treated as an NPA after 90 days overview. Appears to be correct. 10th, no, the account would be classified as an NPA only on invocation and repudiation of the state government guarantee. So what do you say? C or D? As we saw, there is nothing mentioned about the state government. So D option is incorrect. Correct option is C. Clear? Any doubt? Okay, if no doubt, uh, see, what I would suggest everyone over here is that when you are revising this particular chapter, okay, understand one thing: the chapter is required to be revised from a logical understanding. That means the processes, the procedures which are given, they are based on the logical understanding of that particular area. You need to understand that what that area pertains to, and accordingly you need to revise. See, and accordingly you need to understand and read that particular chapter. For example, bank audit. Understand what happens in that particular area. The foreign currency, foreign exchange we saw. Okay. We saw about the drawing power, how practically those things works on the ground. Try to understand that. Okay. And on the basis of that, see what is the audit procedure. Once you will understand the ground procedures which are actually followed by the bank, rather than just reading and just trying to mug up the things, you will get a good understanding when you will see actual procedures. You will try to understand the actual procedures, why and how they work on the ground, and then how an auditor can effectively audit that. Most of you might have already seen inventory. You might be familiar how to audit inventory. Why? Because you understand that practically, that how on ground inventory works, how on ground sales works, how on ground your purchase works. Similarly, for the bank also, you need to understand how on ground these procedures, these areas works. And then you will be able to understand how the audit procedures works. That will give you a good clarity and understanding of the topic, instead of mugging up the all the items which are there. So you are not required to mug up the items, rather understand logically why this is included, why this is excluded, the way we did in the demand and term liabilities. We understood with the logic why it is excluded or included. Similarly with the NBFCs, understand why it is excluded, why is it is included, what is the scenario. And if you understand the logic, you will never forget anything. Now, with respect to the revision part, see, you should not only do the question solving. In order to prepare for a particular chapter, read the chapter, read the study material, attend the LVC lectures, practice the question as much as possible. Okay, and then go for the LVRC lectures, mock test papers, revision. You have a Saransh also issued by the institute, which has covered the all the topics in a summary format, in a chart format, in a very understandable format. Okay, you solve the MCQ booklet. There are multiple MCQs given on the MCQ booklet. All these material are freely available on the portal. So use those material, do practice, ask your doubts. Very important. Ask your doubts, post your queries, and then you will be pretty much ready for the exam, because you have practiced, you have understood the topic. So irrespective of whatever question comes, you will be able to answer in that scenario. Okay, so this is how you need to prepare for the exam. And if you guys have any query at any point in time, you can post, you can reach out to the given helpline numbers, you can mail the queries, and you will be appropriately provided the answers. So mail your queries. There is a helpline number. Ask your queries. and don't use those facilities which are given to you for preparation of the exam and for understanding of the topics. Okay, so all the best and prepare for the exam. And if you have any doubts, you can reach out to the relevant helpline numbers or the BOS portal for the queries, and accordingly those queries will be answered. Okay, so that was our chapter number 14, unit 1, unit 2, that we discussed with the amendments. Practice and read and understand logically the subject. It will help you a lot. Okay, if no further doubts, no further questions, I propose to keep till here. uh okay, then thank you everyone. Ashok ji, session over. Thank you.